Hi, and welcome to a new episode of The Value Creators. Today's interview will be with Diana Meyel, Managing Partner at Cipio Partners. Hi, Diana.
Hi, Stefan.
How are you?
Yeah, good, actually, and lovely to be back again.
It's a pleasure to have you here again.
The studio has much improved since last time.
Yes, that's a very nice invitation for the next interviews in the future.
Absolutely.
So, in order to start our interview, what can you tell us about Cipio Partners? Which snapshot view could you share?
Well, we are a niche private equity firm in the broader growth capital space. So what we do is we buy out early investors in very mature tech businesses, and we do also provide primary growth capital to these companies. It's technology investing, it's a pan-European strategy, and we'll be celebrating our 20th birthday next year.
Okay, happy anniversary then.
Thank you.
Soon. And I think that you also have offices in Luxembourg. What about your presence here?
Oh yeah, actually we came to Luxembourg back in 2007. Yeah, 2007 I think it was. Quite a long time ago. So if you look back at our history, when we started to come into the market, we started as a secondary direct player, and we bought a lot of portfolios. We're a GP for hire, did deal by deal financing, and we had a lot of international investors. And we felt like it was the right time to structure a blind pool, an institutional fund, and to shift the business model from a deal to deal or deal by deal model to a discretionary fund model. So back then, well, we analyzed which would be a perfect location for us, and well, we picked Luxembourg. And so we came to Luxembourg with what we called our sixth fund, but it was actually our first discretionary blind pool back in 2007. So, yeah.
Great choice. If we now look at the value creation model, what are your expectations normally before investing into a new portfolio company?
Okay, so if you look back at the deals that we do, and maybe I have to explain a bit more in detail what we do and what are the deals that we are looking for, because that makes it easier to understand also what's then our value creation. So think about tech investing, venture capital, right? If you read the press, you might easily assume if you're not the one who finds the next unicorn, you did something wrong. But then actually that is just a very, very small portion of the tech market. And if you look at tech investing, it's a bit like building a house or renovating an apartment. It always takes much longer than you originally thought, and you always need more capital than you originally thought you would need. So, and you have a lot of companies, and here I'm following the Gartner hype cycle. You have a lot of excitement when you start the firm. You take on board like 50 business angels. I'm over exaggerating. Everybody's like, okay, well, we'll be rich in 8 years' time. We'll be a unicorn. We'll go public. And then there's such an excitement. And then for whatever reason, this excitement comes down because sometimes it takes longer to develop the technology, to enter the market, you know, not all companies will be unicorns ultimately. And then the excitement comes down, there's a bit of a frustration, and maybe the first business angels want to get out, or maybe the founders in this firm for more than 10 years wants to establish a family, sell part of their position. So there are many, many reasons, or venture firms need liquidity, it's no longer a core asset for them, for why early investors are seeking liquidity. And so these are usually companies that do have a decent growth, that are about to turn profitable in a not too far away future, that are growing nicely, that have 10 million or more in ARR or revenues, so that have their justification in the market. And I'll answer your question about what we are looking for, but I have to set the stage.
No, it's great.
To come to that. So, and very often, you have a very fragmented syndicate in these companies. And very often, these companies operate with a governance that is still, or goes back to the early days. And when you start a firm, a venture capital firm, early investors tend to see a micromanagement governance, because they want the founders to ask for permission anytime they do something. Now, if you're a growth stage company, actually you do not need such a micromanagement. The company should they themselves have a governance that allows them to grow and to scale. And so very often what we do and what we look for is are the interests in any given syndicate aligned? So is everybody working towards the same direction? So do we see an exit for this business? Is there a need for this business and for this product in the market? And so usually or very often we are the last financial investor from the venture or growth capital space that joins any given syndicate. So we have to see the exit. We have to see a company, and especially in these days where we have more recessive environment, we like to see companies that solve a problem, that really address issues that are more like a must-have and not so much a nice-to-have solution. Yeah, so there has to be an exit perspective, there has to be growth in the business, and there has to be some situation where the first hype is gone and the company is now on a growth track where we can see, okay, it's turning profitable.
Okay, that's very clear. Now, concretely, how do you create that value and how do you measure it? Do you have specific tools, techniques you use?
Well, if you, that's a very interesting question. And you get a lot of different answers from a lot of different funds. So in all fairness, I think it comes down to 3, maybe 4 items that we do with what we do. And I would say that the biggest value add, and you would maybe smile at that, is we bring fresh capital. We just provide money. That is a huge value add, especially in the growth capital space, where there is still a structural problem in Europe, which is the lack of growth capital. So there have been some more state initiatives, especially to foster the growth capital market. There has been a lot of capital that has flown into the next unicorns. But what about the league of companies below that unicorn league? And here we still suffer from the lack of growth capital.
Yeah, that's that famous desert, that step in between, yes.
Yeah, because everybody's complaining about there not being enough big tech companies in Europe. And I think you have to, this is like the next generation of Mittelstands companies, if you will, that are being financed in this space. So that's, I'd say, the biggest value add. Obviously, we don't do much to create that value, but it's a value add.
It completely makes sense.
I think the second value add, and this cannot be stressed sufficiently, is to ensure the right people sit at the right place. Sometimes I hear people that say, hey, we coach the founders and we know what's best for the business. Our opinion is like, if we were to know what's best for the business, then we did a poor job in maybe selecting a wrong management team. So things like HR due diligence and really become or generate an opinion on how well the management team will cope with the next challenge and growth. And usually the skill set that you need to found a business and to generate early revenues is very different from the skill set you require to grow a business from 10 to 100 million in revenues. There are examples where you have the original founder team, everybody can dominate all stages of the business, but very often it's like at the beginning you need people that are completely enthusiastic, that just want to do something, want to keep things going. But actually at a certain point of time, you would like to add gray hair to the management team, people that have established sales organizations, more seasoned CFO positions where they have already negotiated financing rounds or exits that have corporate finance skills, not just accounting skills. So it's really different skill sets are required for different phases of a company's life. And that is something where I think, as we've invested in so many companies over time, here we're really experienced, and we have an HR due diligence mechanism that we apply, where we just try to judge the management team if it is the right one.
Okay, and we could summarize that in the perfect casting then for that enterprise.
Yeah, no, actually, that's the idea. And if I were to choose between a company with a terrific technology and a poor management team, or a terrific management team with maybe not such a terrific technology, the team that's going to be economically successful is always the excellent management team.
Mm-hmm. Okay.
So and very often you hear like, our technology is so fantastic, but the team is maybe not, but then they cannot sell the product. And you have to have a story that you can pitch for why somebody should be buying you.
And the members, Diana, of our HR club will be so happy to hear your explanation on that specific point.
And so this directly leads to the third value add that I would like to cite here. And this is help write the equity story and prepare the company for an exit. So why are we good at this? Because we usually do not fall in love with our companies. We are the last one to join a syndicate. One of our key criteria is to see the exit at the moment that we are investing in the company. And so we are very exit driven. We're an M&A machine, I would say. Mm-hmm. So we always have companies that are in exit processes. And it's fantastic if a company gets sold because their product is so fantastic and they are approached by potential buyers, but how often does that really happen, right? There's just very few cases where people, they receive unsolicited offers. In the majority of the cases, you have to have a story, and usually the preparations to have a story that you can tell to potential buyers, that takes time. And usually the exit preparations start 2 to 3 years before the actual exit happens.
I particularly like the M&A machine term.
Yeah, but
very nice.
Sounds a bit pathetic maybe, but...
No, really, it's very interesting.
So that's the third, and one fourth
okay.
maybe. And I mentioned that earlier, if sometimes, and that's a key criteria for us to invest as well, to see that we can streamline and align interests in any given syndicate. And there are cases where you can take out 1 or 2 investors, but you will never manage to align interests. So you better not touch that investment, you better not invest, because if you don't have interest alignment at the beginning, you'll not be having it later on. So better not do that deal. But very often there are situations where there is just 1 or 2 problematic investors, or where the company's growth is being hindered by wrong governance, by this micromanagement governance, where it really helps if we just provide the company with completely new legals, if we take out certain investors, and then provide the company with a new basis to scale the business.
And would you have an example which could illustrate those explanations?
Yeah, actually, so you mean like one case study that
yes.
I could cite? Yeah, absolutely. Maybe the first case study which makes sense here is we can use it for all cases, for all 4 dimensions that I just mentioned.
Great.
So it's a company which is called B2X. It's headquartered in Munich, but it's active globally. And what does B2X do? They are a tech-enabled services company, and they do after-sales and repair services for mobile devices or for connected devices. And so if you look at, for instance, Apple has Apple shops in most cities and countries. They do that they themselves. But I think they do not have, in some Asian countries, they do not have own shops. So they are dependent on local partners to do that for them. Or look at, for instance, we're an exclusive partner to Xiaomi in Europe, and there are other, a lot of manufacturers that do not have their own after-sales and repair services organization, so they outsource that to B2X. B2X has a tech platform where they add subcontractors and steer and control the quality, do the pricing, do the contracting and everything. So that's what they do. When we invested into this company, it was more like a services business. The first thing we did here is we changed the management team. So a management team, the one that we installed were people like more like not so much venture guys, but more like mid-cap buyout guys that knew how to turn companies profitable. And we provided the company with fresh capital to turn profitable, to provide working capital, and to also develop the platform or the technology that they now operate with. Secondly, what we also did when we invested into this company, there was quite some, I'm not saying weird governance, but really like governance from the early days. So here we really reset the governance completely and said, look, well, we trust the new management team. You just develop the company, and our work is only to ensure that you stick to the framework that we have defined, but not more. And lastly, and actually, when you speak about ESG, everybody's always focusing on E and on S, right?
Completely.
But governance can do so much harm if it is not looked after properly. So very often by nature we focus on these governance items. So the last thing I'd like to mention here is that if you look at these themes, after sales and repair services, so you could think of circular economy aspects. So the last thing we did here is we helped the company bring somebody on board, which we knew from our network, that helps them write the equity story and kind of position the company in this circular economy theme. Like, you can use your handheld devices much longer if you repair them properly. You reuse them. There's no need to buy new devices each time your contract is over.
On one side, it's very trendy, but also efficient, and you're doing something good. So yes, that also completely makes sense.
Yeah, and it's really interesting because it has been like, I'm not saying a not so fancy repair services business in the old days. And now if you look at it, it's really tech-enabled services with a circular economy spin. And the company is break-even, is growing nicely. So I think that's a very good example.
Very good example. Thank you, Diana. Would you have another one you would like to share?
Mm-hmm. So the second example I'm thinking of, that is a French company. It's a software or SaaS business. It's called Launchmetrics. And Launchmetrics is maybe by now the biggest independent software player in the fashion, luxury and cosmetics industry. So they just focus on this industry vertical. And when we looked at this company first, it had a different name and it was not so much focusing just on that vertical, and we declined to invest in the business. But we liked the CEO, so we stayed in touch, and I think we invested 2 years later with a different fund. So with our second Luxembourg fund, we ultimately invested. And the company by then was in a repositioning mode. So we helped buy out some tired shareholders. We provided the company fresh capital to pursue a buy and build strategy. So we joined an existing consortium, so we were not the lead investor here, but together with BPI from France.
Oh, yes.
and other well-known French investors, we participated in this buy and build strategy. And today, the company is is break even, has become the biggest player in this industry vertical, and is growing further actually. And now we are even talking to some bigger private equity funds if maybe they invest alongside us and make this success story even bigger.
Great, and then I really thank you for sharing all these examples out of your deal chest, and we're very happy to also bring them to our audience and community. We wanted to wish you some happy, nice holidays and great successes for 2023.
Thank you. Yeah, well, same to you.